Today we're talking about alternative asset classes and how and why they should be in your portfolio. An alternative asset class is not a stock, it's not a bond, it's something completely alternative. So historically in the CPP and historically in all these endowment funds, the largest ones in North America, they used to have nothing but stocks and bonds. And then in the 80s something started happening. Harvard, MIT, the CPP started adding alternatives. They would buy actual private equity. They would buy companies. They would look at private real estate. They would look at infrastructure. They would look at private debt. Anything to get an alternative asset class. The key is to have it uncorrelated to the performance of the stock market. Why does that matter? Because when you're getting crushed in your portfolio on your stocks, like 2018, you want to be able to have a portion of your portfolio that actually has gains, that made money, and that didn't fall with the rest of the portfolio. So that's why we love to have alternatives. That's why we've consistently built them and consistently outperformed on the portfolio side, is because of our alts. So the alts, I'll give you a couple examples. One easy one is private Reits or limited partnership real estate. So those very low volatility, very little movement in the actual asset class performance. The shares are fairly stable. They pay a consistent cash flow. It's very tax efficient. And over time, they've had consistent growth kind of in the 13 to 15% range. So if we can add that to a portfolio when the markets are up or when the markets are down, that's a phenomenal asset class to own and does wonders for risk-adjusted returns. An alternative to that would be private debt. So private debt would be I own the mortgage on a building, on a property, on a development, something like that. You know, if we're able to get 7 or 8% on private debt using first mortgages, that is something that I want to own for my clients. It's defensive. It's got a core structure that is generally very, very conservative in nature. It pays monthly income, and my clients have a security on their assets. That's a fantastic replacer for a portion of a fixed income portfolio. Consistent cash flow. Another one would be a structured notes or a principal protected note or an equity linked note. We love these because we can structure these specifically for clients. And I'll give you a very straight and simple example. We take an underlying asset class, we tie it to a bank style bond. So it's a bond issued by a bank that guarantees the future capital. So capital is guaranteed. Clients then get to perform and participate in the upside of the market. So if the market is up 10% per year, clients get that benefit while having the full principal protected. It's an alternative asset class that has grown immensely in the last few years, and if you're not participating in this type of asset class, you really should consider it. It's a no-brainer. It does wonders for the risk-adjusted returns of portfolios. Now finally, you could also look at some private equity. So there's a lot of private equity deals that are structured. This would be, you'd consider like a hedge fund type investment. Now, not all hedge funds are created equal, but a lot of them are very, very risky and not something we want to do. We like to focus on the conservative ones that have private equity that we know, we trust, we know the management, and we know they provide good work. So if we're able to focus on those 4 or 5 different asset classes that have either way less volatility, no correlation to the market, can provide cash flow or can provide capital protection, well, we're doing amazing work for you in your portfolio. So that's why we love the asset classes, and to me, you should consider having these in your portfolio. That's it for today. Please share if you like the video today, and don't hesitate to throw your comments under here. We'd love to hear from you.